Hey Steve, how's it going today?
Pretty good.
It's kind of interesting this time of the year. Makes me think about Benjamin Franklin. If you think of Benjamin Franklin, what is your major takeaway? What is he famous for?
A lot of different things, whether it's the electricity or his bit almanac or his inventions or his politics. He did quite a bit.
Yeah, I think of him being more famous for this one particular quote other than anything else. And that quote is, "In life, nothing is certain except for death and taxes." And this time of year, right, is something that a lot of people are thinking of taxes with the deadline that just happened recently. And most people don't think about that, but that's certainly one of the other things that Ben Franklin is known for, all these years later. And, it's kind of interesting to have this conversation about taxes after the major tax filing happened in the US, but there's a reason for that, because I think a big focus that we want to look at today is there's a major difference between preparing taxes, what people just did, and planning taxes, the way that you can utilize better strategies to change what happens next year. And if we just kind of start there, how would you look at the difference between those two things?
Well, yeah, again, planning, or excuse me, preparing taxes, it's a calculation, and I'll compare that to accounting. I have a degree in accounting, and what we did with accounting is after all the work is done, after a company has done all of its marketing and sales and spent the money and budgeted and did all those things, this is a recording of what happened after the fact. Accounting is not planning the future of, hey, here's what this company is going to do, here's the direction, here's how to be more efficient. It doesn't cover that. It is a reporting of what has happened. And that's really what your tax preparation is. It's a recording, a reporting of what has already taken place. Tax planning is, okay, how can we maybe pay less taxes next year? How can we plan to minimize that obligation? So it's more of a planning and strategy. Whereas what most people do is they just prepare, well, here's what happened last year, let's calculate. So
Right. And if you think about, approaching that another way, real world concept, the middle of April is also kind of just after the end of March Madness. I know you're a big basketball fan. The national championship tends to be in April. And, if we look back at the past, right, we're focusing on the results that have already occurred. And it's kind of the same thing when you're filing your taxes. You're looking at what already happened. And what we're really talking about is what are some of those strategies that can be utilized to adjust what happens next time effectively to make it so that we have a stronger approach to have a better winning approach when it comes to paying, less taxes like some of the biggest and most wealthy people in this country are. There's that classic saying about Warren Buffett where he pays less in taxes than his secretary. And many people look at that and say, how is that possible? Tell me, Steve, how is that possible?
So again, it's planning, just like you said. And I'll go back to a different basketball analogy. It, what tax preparation, that's your score at the end of the game. But before the game starts, all right, here's what we're going to do. Here's how we're going to run the offense. Here's how we're going to run the defense. Here's our strategy so that when you do get to the score at the end, you're on the right side of it. And that's what tax planning is. I'm going to start with a little clarification on what scares most people about tax planning. Because again, you mentioned death and taxes. Most people, and that's pretty ominous. Most people, they've heard that saying, whether they knew it was Ben Franklin or not, they've heard that saying. And when you're lumping those two things together, most people think of it that, hey, there's no way out. You just have to pay. That's the way it is. You just there's not much you can do about it. You just have to pay your fair share and suck it up and keep going. And so they think of it as something that they have no control over, like death, but that's not the case. And you have other people who say, well, gosh, if you're reducing your taxes, you're cheating the government out of things. You're screwing over other people because you're not paying your fair share. And I want to address that second part, because if you look at tax planning, it's not how do you get out of taxes, it's how do you take advantage of the tax laws that are in place. And if you think about it, the tax laws that are in place were written by the government to encourage certain behaviors. So, for example, in the 70s, they realized, my gosh, we have this huge baby boom issue. In the 70s, they were in their 30s. And they're like, wait a minute, we're not going to be able to cover Social Security when these people start retiring. we need to create some incentives to encourage people to start saving for retirement. And that's when they came out with 401ks and IRAs and ways where you could get a tax deduction by setting money aside for your own retirement instead of just being dependent on Social Security. So the entire, like I said, 401k, IRA, retirement planning system came about to encourage people to take a certain behavior. And we've seen the same thing with, when there was the first time we had oil and gas price issues, what happened? Well, they created some incentives for alternative fuels, for solar, for hydroelectric, for other types of fuel so that we weren't so dependent on oil from the Middle East. And so they offered tax breaks for those things. Okay. And so if you look at the tax system, it's there to encourage certain types of behavior. Again, to encourage housing, building houses, to encourage starting business, which provides jobs. When people have jobs, they're paying their own income taxes. And so all these different things the government does encourages certain behaviors. So when you are planning and you're trying to minimize your taxes, you are just using those strategies created by the government. So I just want to kind of point that out because again, you're not trying to, get away with anything. As a matter of fact, one of the things you probably heard me say this before, when it comes to paying taxes, if I'm not sure, I'm paying the taxes. I don't want to be the wealthiest person in my jail cell. It's not worth going to jail over not paying your share. I mean, that's tax evasion. Yes, that's a crime. But reducing taxes is tax planning, and that's something that I encourage people to do.
I think that's a great point. So much about wealth creation, wealth building goes back to understanding the rules of the game. And sometimes people are playing by an entirely different set of rules. And there's a difference between the rules that are actually on paper versus what one presumes the rules to be. And just one other aside about paying taxes, it is the rich who are most often the ones who are taking advantage of these other rules that we're talking about. But simultaneously, it is also the rich that pay the majority of taxes within this country. So it's not about that exploitation or trying to pull a fast one. It's more about saying, hey, we have this opportunity to adjust what we're paying. So let's take advantage of that. And part of the reason why the government wants us to take advantage of that goes back to literally stimulating the economy. And if you think about it from that perspective, it's certainly my understanding that there are some major incentives for a variety of different categories, whether it's real estate or business. If we look at being a business owner, having a 1099 versus a W 2, what strikes you there in terms of what some of the advantages are that are there and why those rules exist to have those advantages?
Yeah, I mean, there's all sorts of different deductions. And again, have a CPA. If you're a business owner, make sure you've got a CPA to help you take advantage of all these different deductions that are there. And some of them, especially like in a startup phase, when you're first starting a business, a lot of times it takes losses. Well, why would somebody do that? Well, maybe to get a business going, but when there's a government deduction for a loss, it helps to soften the blow. All right, hey, I'm going to get through this. I'll take some tax deductions in the first year as the business is growing. Okay, and then you maybe pay more taxes later on. Why would the government do that? Because what's going to happen when you get that business going and you've got 5, 10, 50, 100, 1,000 employees, you're now supporting the economy. You've now got 1,000 people that are now paying their own income taxes to the government. So the government wants to encourage those businesses to succeed. That's why they have some of those deductions to kind of help with the business along. So I'm not sure if that's quite exactly what you meant, but that's one example.
Well, certainly, yeah. I mean, if you look at that, it goes back to the business owner. They're taking a tremendous amount of risk, and many of those opportunities that they pursue, some of them work, but some of them don't. Many of them don't, especially as sometimes, what is that classic saying that failure is the best teacher? And it's, that's what can make entrepreneurship so scary. But simultaneously, there is something to be said about your willingness to, step back up after failure, pick up the pieces, learn from it, and then get to a successful business. And many people have gone down that exact sort of road. But when we look at it from a perspective of thinking about some of the actual benefits or the write-offs that a business owner might have versus a W-2 employee. I mean, what really are the differences there that you see as a successful business owner yourself?
Well, so a couple things. I will tell you, I'm much better at the real estate deductions than I am the business deductions. So we can talk about those in a minute if you want to get specific. But as a business owner, I know that, when I'm, driving to, to something that's a business meeting, my fuel is tax deductible. My office, I pay for this. I had to create this. That's all tax deductions. What I meant earlier is if you're losing money in the first few years, you take some tax deductions there, but those losses carry forward and you get tax deductions when you start making money. And so that's one of those ways it helps a business that, hey, it's finally gone from losing money to making money, but instead of it draining, say, hey, we finally made money, but it all goes to taxes. Well, actually, no, you got some carryover losses to soften that blow so you can so you get to keep a little bit more as the business starts growing. So there's all sorts of tax deductions for your expenses and different things like that you get to take advantage of. And again, I know you're asking about business, but I'm more familiar with some of the real estate deductions. So a couple of examples there. Obviously, a lot of people are familiar with the interest. If you borrow money to buy an investment property, the interest on that loan is going to be tax deductible. You also get to deduct depreciation expenses. Okay, that's a pretty good one. There's some special things that came out in the Big Beautiful Bill where you get some additional deductions as well, some accelerated depreciation and different things like that, more deductions. And it just kind of keeps going and going. There's deductions year after year that you own a property. And I will tell you one of the biggest secrets that most people don't get about real estate investing is, and again, I had a conversation with my mom. She picked up a couple of rentals years ago and she's like, yeah, we finally got them paid off. And that's what most people think. You just want to get them paid off and then you live off that income. And that sounds great. But if you've got a rental property, it's paying $1,000 a month. That's nice. Okay, you're making $1,000 a month. That's a little bit of income. But if you refinance that property, and depending on the value of the property, if it's worth $200,000, you could refinance it and pull out $150,000 tax-free all at once. Okay, when you refinance, it's not a taxable event. If you sell the house, you have to pay taxes on the gains. And what you'll find is if you look at wealthy people, that is one of the biggest tax breaks that they take advantage of, is they don't sell their assets, they use them as leverage, as collateral. And I can show you hundreds and hundreds of examples of that, whether that's in real estate or going back to business. You look at some of the wealthiest business owners. I know one of them is Peter Thiel. He's made billions and he pays very little in taxes because he doesn't sell his shares. He uses them as collateral and borrows against them. And so that's one thing you can do, whether you own a business or you own real estate. But that's just one of the more advanced tax strategies that people don't even think about. They think that you want to buy a house, maybe it goes up in value, then you sell it and you pay taxes on the gain. Well, you lose your cash flow machine, but you pay taxes on the capital gains. Whereas if you just refinance it, you get tax-free revenue from it. Again, it's not income because it's a loan, but it is cash flow into your pocket that you get to use to cover your expenses.
Well, one of the things that brings to mind is there is something that very interesting that happens, and I believe there's a classic even saying about this, that effectively you continue to borrow until you die as a strategy there. But then the other side to that is the way the IRS at that point treats the value of that asset when you do die. There's something special about that, right?
Well, there's two things. First of all, and again, I don't know who came up with this phrase, but you are correct. It is usually called refi until you die. That is the tax strategy. Refi until you die. You're right. But then even then, when you pass away, it's called stepped up basis. And so if you've got a house that that when you do pass away and whatever the tax basis of that is, when that passes on to your kids, they're going to get a stepped up basis. So they're not going to have to pay quite as much taxes on it either. So yeah, that's one of the tax advantages. When you pass it on to the next generation, it continues to have tax breaks and tax benefits for whoever owns it at that time.
Right. And if you look at it from that perspective, it almost links up to the classic approach to the BRRR method in real estate, right? That leads directly into utilizing that strategy. And if we think through, what that is, just for anyone listening as a refresher, the BRRR method is what again?
Yeah, so I'll go through the whole process because it's fantastic when you understand all the pieces. So the BRRR process is you buy a property, usually a distressed property that needs a little bit of work. You buy it, then you rehab it, and then you rent it out for cash flow, and then you refinance it. And when you refinance it, you usually get back whatever you've put into it. And so, quick example, if you bought and rehabbed a house for $200,000, instead of flipping it, and let's say it's worth 250 now. So you bought it and rehabbed it for 200, now it's worth 250. Most people would say, yeah, it's $50,000. I'm going to sell that real quick. Well, if you do, you're going to pay gains on the taxes, or excuse me, taxes on those gains. But if you refinance it, you can get your 200,000 back out and you still own the property. And so you go do it again. And so you could do that. Let's say you did that twice a year, every 6 months or so, you pick up a new property, you refinance it, pull your money out, and you go do it again. Well, after 10 years, you would have 20 properties. Again, it's that same $200,000 you started with, just getting recycled over and over again. But now you've got 20 properties. They're all cash flowing, and it's decent cash flow. Maybe $200 or $400 per property per month. 20 properties, it adds up 4, 5, 6, 8,000 a month. That's not bad. But in year 11, based on 4% appreciation, you would be able to pull out $100,000 per property. So what you could do in year 11, you refinance the first 2 properties you got in the first year, and you pull out over $200,000 tax-free. In year 12, you refinance the properties you bought the second year. And then in year 13, you refinance 2 more. So every year, you're pulling out $200,000 of tax-free cash from those properties based on the equity and the appreciation of those properties. And then you do that for 10 years, and then guess what? In year 21, the one you refinanced in year 11, it's had 10 more years of appreciation, 10 more years of mortgage paydown, you refinance it again. And so it creates cash flow, but not from the rent so much as it does from those refinances that's tax-free. So that's one of the tax strategies for building a portfolio, using the BRRRR method to build a portfolio of real estate that creates cash flow from rent, but then also tax-free income when you go to refinance it.
Just to recap what you just said there, it takes a little while. It's not instantaneous. In a hot market, potentially you can refinance sooner than a decade.
That's correct.
But either way, eventually you refinance. And the assumption that we're making is that the mortgage that has been refinanced gets paid for by rent.
Yep.
And so now you have this money that you can basically take out cash free. What's the catch? There's no catch there.
No,
It's
so
just your money. It's not income.
correct. So when you borrow money, that is not a taxable event. So that's, again, there's no catch there. I guess the closest thing to a catch would be, hey, your monthly payment just went up. So if you had so let's say in year 1, you refinanced that property, it was worth 250,000 and you financed 200,000. And so you're paying a mortgage payment based on a $200,000 property, or excuse me, a $200,000 loan. In 10 years, not only has that property appreciated from 250 up to around 350, or at least over 300, but that loan that was 200 is now down to 180 or so. Okay. So then when you refinance, it's going to be based on the higher level, the higher appreciated price, and you pull out your 100,000. Well, now you owe maybe 280. And so you did owe 180. You've pulled that equity out. You owe 280. And so your monthly payment is going to go up. But keep in mind, rent has been going up for 10 years. And so the cash flow still works. It's just that, it's going to squeeze that, so by then you might be making $600 a month at net. You refinance it. Now you're back down to making $200 or $300 a month net, but you pulled out 100,000 in the process. So the downside, if you wanted to call it a catch, is you owe more on the property, your mortgage payment resets, and your monthly cash flow isn't quite as high, but you get a huge lump of cash, tax-free cash.
I see. So to put it another way, one of the things that we talked about was the difference between W-2 versus 1099 income. And, one of the things to think about is your distribution there by refinancing, which is effectively income in another form. That's something that is entirely tax-free versus W-2 income, you're naturally paying taxes on it, right?
Correct. So I want to talk about something there. I'm glad you pointed that out. One of the things I talk to people about is what I call, it's a strategy. It's layering your future taxes. Okay. And it's strategy. But think about when you retire down the road, whether that's 5 years, 10 years, 20 years, how are you going to be getting income every month? Okay. Maybe it's coming from some businesses you own, some real estate you own, 401k, IRA, variety of different things. You got a stock portfolio over here. what you want is you want just like people talk about diversification of assets. So if the market crashes, it doesn't destroy your entire portfolio. You want diversification of your taxes. So what I mean by that is you want the ability to say, okay, I'm going to retire in year 15. And in year 15, I want the ability to pull some money from wherever I need to minimize my taxes at that time. And so maybe income taxes have shot up. Well, okay, then I'm going to reduce my income taxes and I'm going to pull more from my real estate. I'm going to pull more from this pool over here. I'm going to pull more from my Roth 401k because that's tax free. Maybe you pull a bit less from your Roth, from your traditional IRA or your traditional 401k. So what you do now is you have a strategy so that you've got income that's either going to be tax free from a couple of sources. You have income that's going to be taxed as capital gains from a couple sources. So maybe you've got some money in stocks, in something else where, okay, if I'm going to sell that, I'm going to pay capital gains tax on that piece. And then you've got income over here that is going to be taxed as income. Things inside your 401k or IRA that are traditional, not Roth, but traditional IRA or 401k. Maybe you've got a few other sources, part-time job or whatever it is, a side hustle you like doing. But you're going to have, some taxed as income, some taxed as capital gains, some that's tax-free, and you can balance that. And so you've got diversification of how you're paying your taxes. And just real quick, the flip side of that, if people who don't plan, what I've seen happen many times is they get to retirement and everything they have is in a 401k or IRA, and every dollar they pull out is taxed as income, which is the highest tax rate. And so they didn't plan ahead, and they're like, okay, yeah, hey, I'm pulling out $100,000 this year, $200,000 this year, but that's taxed just as if they were working. It's taxed as at the same tax rate as if they had a job, and a lot of it goes to the government. Whereas if they had made some of that Roth, some of that capital gains, some of that tax-free, they'd be paying a fraction of the taxes.
Yeah, you bring up a great point there. And there's two sides to it that immediately jump out to me. They talk about for the middle class, for a lot of people, one of the primary investment vehicles is the home that you're living in. And in some sort of way, what that really is an investment vehicle, the appreciation that happens over time. And, when you do finally sell, maybe you're even downsizing, right? There's a large percentage, whether you're single or you're married, that you're able to take and roll directly into the next home tax free. And so, but thinking about the plight of people who haven't thought through some of those sort of things, that's a painful lesson to have in your 60s or 70s or whenever you're retiring
Right.
to suddenly have all that money go right back to the government. And that of course makes me think, again, going back to that W-2 1099 discussion, for most W-2 employees, when they're doing their taxes, they're likely to use the standard deduction. It's oftentimes they're not going to itemize. But naturally, as a business owner, someone who's filing, on a Schedule C or 1099, they are itemizing everything in the first place because it typically hits their business income before it ever floats through to their personal income. And is there anything that would immediately jump to mind to you there in terms of some of the strategies and how it is different from a W-2 employee?
Honestly, I would say talk to your CPA. I know there's strategies. I know there's things. Seriously, that is not my area of expertise on the employee side. I've been a business owner for so long. I'm not even sure. I'm not sure what it is to pay taxes as an employee.
You don't even remember anymore.
I
Well, I'll put
remember
it this way, right?
it was the
I'll put it
90s.
this
The
way.
last time I paid as an employee was the 90s. So
It was a different era, right?
yeah,
But I mean, one of the big things to think about there, from my perspective, looking at it is, typically speaking, because you're not itemizing as a W-2 employee, if you're buying stuff for your job, it just floats into the standard deduction. Versus as a 1099, a small business, if you're buying something for the business that you're in, new equipment, as an example, could be a work vehicle, if that's something that makes sense in the trade that you're in, that's something that you can actually deduct before you get to the standard deduction, which makes a major difference in terms of how it impacts the bottom line from a tax perspective. And so that'd be one thing that would jump out to me. The other thing that jumps out to me, yes, typically when you're working for a company, you're going to have some sort of ability to focus on something like a 401k. That 401 is going to be taken directly from your your typical salary at that business. Whereas if you do a solo 401k, the rules are quite a bit different. And there's those two things that speak to mind to me, and I'm sure one of them you'd be excited to talk about. Yeah, go ahead.
Well, yeah, I was gonna say, because even before you started talking about year two, I wanted to mention that second one anyway. That's where I was going to go next, because one of the things
Okay.
that I've done is, and I've helped other people do this, is if you own a business, even if it's a part-time business, you're the owner. You're getting income from it. You're getting cash flow from it. You can put up to half into your 401k. So you set up a little business, you're the owner, maybe it's taking an hour a week of your time, that's it, but it's making $5,000 a month. Cool. Well, what are you going to do with that 5,000? You could put half of that into your 401k for your future. Okay? Up to about $55,000 a year. See, as an employee, you can only put in up to, I want to say 19,000, give or take right now. But what happens is you actually hire yourself as, you're an employee of your own business. So I am actually an employee of my own business. And as an employee, I can set aside about $19,000 into my 401k. But my employer, he's a wonderful man who has this matching program. And so my employer puts a bunch more money in. And then there is it's a profit sharing plan. My employer is so nice. He actually shares profits with me, and I can contribute another portion from my employer, which is me, into my plan. And you add all those up, and I can currently put in more than $55,000 a year. So if you think about that, if you had a side business or two that were making $10,000 a month, you could put half of that into even a Roth. And think about that, half of that into a Roth every year. How many years would it take to have an amazing 401k sitting there, on the side? And, think about that. You did that for 10 years, 50,000 a year. That's a $500,000. And because you're putting it into a Roth, you will never pay taxes on the gains, never pay taxes when you pull it out. And so that's one thing I show people how to do is you need a side hustle or a side business, even if it's only an hour a week, but it's funding your future Roth tax-free retirement income.
Well, and one other really interesting thing to think about there, Steve, especially if you're looking at it from like your classic 401k or some of these different things that you can offer yourself as a business owner or a business employee for yourself, it's that ability to invest in different things than what your typical company sponsored plan might be, which is most likely going to be focused on funds and basic stocks. It's pretty rare for it to be focused on alternative assets, which is something that you have the ability to do when you're the plan administrator.
Right. So let me explain that. If you look at the 401k plans that are out there from employers, most of them are organized by companies like Fidelity, Schwab, Merrill, places like that. They are securities companies that by law can only offer securities in the plan. That's the rule. They cannot offer non-securities. They can't offer bars of gold. They can't offer a rental property. They can offer a fund, a mutual fund tied to real estate. They can't offer crypto. They can't offer these things because those things are not securities. They are restricted to only offering securities. And when you have your own 401k, you can do like I did. It's called a self-directed 401k. I've got an administrator who makes sure it's compliant with all the IRS regulations and does all that and reporting and whatnot. But there is a specific list of items that the IRS allows you to invest in inside your self-directed 401k or self-directed IRA. Real estate, gold, crypto, private lending, all those things are allowed inside my self-directed 401k. So Dave, to your point, you've got a lot more flexibility in what you can do with it. Now, if you're an employee and maybe you've got one plan over here, and then you have a little side hustle business that you start up and it's making some additional money, you could have a separate 401k that is self-directed. And so this one over here with your company, your boss, your employer, you got that in the stock market and whatever things they have. And then self-directed one over here, you've got in some alternative assets, some diversification, some different things over here. So again, it's another way of diversifying.
One of the things, just this speaks to me too. One of the things that you often see with relatively small business, mostly a home office type thing, is oftentimes they will employ their family or their children. And particularly when the spouse or the children aren't working regularly, there's actually some great benefits there too from a tax strategy perspective. And it goes back to that same sort of thing where, hey, if I have that opportunity to invest in my children's future or to pay them some of my business profits instead of that going straight to the government, completely legal thing to do. And of course, they need to work in a way that is allowable by the IRS. Just paying them for existing is
Right.
not allowable.
Yeah.
But that's a strategy that I often see. Any thoughts on that at all?
You're right. I've seen that strategy. I never took advantage of it. Again, I just never really had, my kids, got jobs and they just wanted to do their own thing, and it was never really fit for us. But I knew it existed, but I never took advantage of that deduction. But yeah, I know that is one of the more common ones.
Hey, Steve, if we kind of, look at what we've talked today, I mean, we barely scratched the surface of some of the different tax strategies that are out there. But the big thing to think about, even though the 2025 tax year is, now in the rearview mirror, what we're talking about today is what people can start building to for 2026. And certainly that's something that within the unbroken investing community, it's something that a variety of different experts are focused on. Anything you want to speak of there?
Yeah. So there's several different opportunities. Just so you know, there's something called QSBS. There's an opportunity zone. And there's different types of ways that you can really reduce your taxes with specific types of investments. And I spoke with one of those this morning. He's going to present to our community in probably about 4 weeks or so. And it's amazing what you contribute to that. It actually generates cash flow, but the amount that you are contributing, you get to deduct it against this year's taxes. And so you could actually put in $100,000 into this investment in 2026, and it would reduce your taxable income in 2026 by $100,000. And so it's an amazing offset for people who says, man, maybe they did something that is causing a large tax event. Like, okay, my income's really high this year because I did this, or maybe they wanted to convert. As a matter of fact, I did this last year, converted the last part of my traditional 401k to Roth. Well, to do that, there's a tax consequences. And so basically the government says, hey, it's like pulling money out of your traditional and then making an investment into Roth. So I had to pay taxes on that, but I had this huge offset that I could use to do that. So it was essentially a non-issue, but now my entire 401k is in a Roth. So it's all going to be tax-free later. And so you can use investments like this that have huge deductions now to accomplish a lot of different things. The point is, there's tons of puzzle pieces. It's just a matter of how do you want to put them together. What is a fit for you? What's your time frame? What's your horizon? What do where are you now? What are you trying to build? How do you create a diverse tax strategy that when you're wanting to live on your income, you're protected and you're not just subject entirely to income taxes. So that's how I would look at it. And that's the type of thing we do in our community. I have fun doing it. Again, I'm not a tax expert. I know what some of the rules are, what some of the potential is, and I share some of those. But then, in heck, I could introduce you to my CPA. But you would want to go to your CPA and make sure that you apply them to your specific situation.
Right. And I think to your point, just to end on those few notes, you don't get better at tax strategy without working on tax strategy. And of course, that's one of the things that we can all devote more time to. But the other kind of takeaway that I have with our discussion today goes back to that idea of the major difference between preparing taxes versus planning for taxes. And if you're planning for taxes only when you're preparing your taxes, there's most likely a lot of different income opportunities that are being missed simply because you haven't properly positioned your own wealth building within structure necessary to leverage the tools that the system that was designed by our government has in place.
That's right. Yeah, that's a good summary. So plan.
Okay, well,
Don't just prepare
go
your
ahead.
taxes. Plan your taxes.
Exactly. Well, thanks for your time, Steve. As always, we'll catch you on the next one. And other than that, everyone have a great day.
Awesome. Thanks so much, Dave. Appreciate it.